I know the numbers bore your audience, but the aggregate federal debt is $130 billion. The net trillion, I'm sorry.
Trillion, yeah.
Net revenue, the gross revenue of the US dollar, the government, before they spend a dime, is $5 trillion. You see the problem? The size of the problem is 26 times the size of the solution. That the on-balance sheet obligations of the US government increase by $2 trillion a year.
Yeah.
In other words, any savings is used up in reducing the deficit. The off-balance sheet liabilities, which are Medicare, Medicaid, Social Security, that increases by another $2.5 trillion a year. The deficit between on-balance sheet and off-balance sheet currently is the same size as gross federal revenues.
For decades, the United States has operated under the assumption that its debt levels, no matter how high, can always be managed. The government spends freely, financial markets continue functioning, and the dollar remains the world's dominant reserve currency. But what happens when these assumptions no longer hold? What happens when debt reaches a point where it cannot be sustained without severe economic consequences? We are now witnessing an unprecedented fiscal trajectory. The national debt has surpassed $36 trillion, growing at an accelerating pace. Interest payments alone are projected to exceed defense spending by 2025. Social programs, once considered untouchable, are under increasing strain as unfunded liabilities, those tied to Social Security, Medicare, and Medicaid, expand beyond $100 trillion. One of the most vocal analysts on this issue is Rick Rule, a seasoned investor with decades of experience in resource markets and financial cycles. He warns that the U.S. government's fiscal irresponsibility is pushing the economy toward a sovereign debt crisis that could have profound implications for financial markets, the dollar's stability, and the role of hard assets like gold in protecting wealth. Rule argues that the government's current trajectory of increasing liabilities by over $6 trillion annually is unsustainable. He believes the problem stems not from insufficient revenue, but excessive spending. To address this mounting debt, Rule suggests that the government may resort to inflating away the value of these obligations, similar to the approach taken during the 1970s when the US dollar's purchasing power declined by 85% over a decade, and gold prices surged from $35 to $850 an ounce. In light of these fiscal challenges, Rule anticipates a renewed interest in gold and precious metals as investors seek hedges against currency devaluation and economic instability resulting from government overspending. We will present clips from Rule's recent interview with Mining Network. As we do, please share and like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. These actions help with the YouTube algorithm and help our videos reach more viewers. We appreciate the support and hope you enjoy the video.
Your audience should read The Triumph of Politics by David Stockman, which details the derailment of the Reagan Revolution in 1980. The most recent Republican budget last week didn't deal with the deficit, never mind the debt at all. Let's put it in context. The aggregate US government debt includes $30 trillion net, in on-balance sheet obligations, and well over $100 trillion in unfunded obligations, entitlements, $130 trillion. To put that in context, it's more than 4 times gross domestic product. It's 26 times the gross federal budget before they spend a dime.
But Rick, he's going to sell a load of visas and it's going to cover the debt.
Elon is a known consumer. Now, I mean, I think how this ends. Yes, they cut some expenditures. And yes, they rejig entitlements. Old rich folks like me, they take away the cap on Social Security at the same time that they means test our benefit. In other words, they steal our contribution. And they raise the eligibility years. They have to do that. And then they inflate away the net present value of the obligation. In the 1970s, in the United States, we reduced the purchasing power of the US dollar by 75% in 10 years. That's a tax. But you can politically honor the nominal obligation if you inflate away the net present value of the obligation. That's how this ends. People need to understand that. There is no arithmetic alternative. One more time for your audience. There is no arithmetic alternative. And I don't think, just like you said, we don't need to do the numbers. People don't like to do the numbers. It isn't until people do the numbers that they understand the reality of the situation. So I think we paper over the problem for at least 2 years. Okay. Because people don't want to face reality. When people talk about fraud and abuse in government, they're talking about benefits they don't get.
Yeah.
The benefits that they get are necessary and needed. The benefits that other people get are fraud and abuse. You can pass this down the road for a while. We did it through the decade of the 50s and 60s. In the decade of the 70s, the war on guns, the war in Vietnam, the guns, and the war on poverty, butter, came home to roost. We lost both, of course. What we were left with was the bill. And in the 70s, we paid the bill by depreciating the value of the US dollar over 10 years by 75%. So, I know the numbers bore your audience, but the aggregate federal debt is $130 billion. The net trillion, I'm sorry.
Trillion, yeah.
The net revenue, the gross revenue of the US dollar, the government, before they spend a dime, is $5 trillion. You see the problem? The size of the problem is 26 times the size of the solution. That the on-balance sheet obligations of the US government increase by $2 trillion a year.
Yeah.
In other words, any savings is used up in reducing the deficit. The off-balance sheet liabilities, which are Medicare, Medicaid, Social Security, that increases by another $2.5 trillion a year. The deficit between on-balance sheet and off-balance sheet currently is the same size as gross federal revenues.
I'd like to hope that there's still a glimmer of possibility that the US could get themselves out of this trouble.
We will get out of the trouble, but it will be extremely inconvenient. We got through the decade of the 70s. We did it by inflating away the net present value of the purchasing power. We did it by reducing American standards of living substantially over the course of the decade.
Yeah.
And that's what's going to happen again. In a biblical sense, there needs to be a reckoning. Maybe not as deep a reckoning as there was allegedly in the Bible, but certainly as deep a reckoning as there was in the decade of the 70s.
Historically, governments facing excessive debt burdens have relied on inflation to erode the real value of their obligations. The U.S. experienced a similar scenario in the 1970s, when a combination of high government spending and monetary expansion led to stagflation, a period of sluggish economic growth accompanied by soaring inflation. During that decade, the purchasing power of the US dollar declined by approximately 85%, while gold prices surged from $35 per ounce to $850 per ounce, reflecting a loss of confidence in fiat currency. Given these parallels, Rule suggests that gold and other tangible assets may once again serve as critical hedges against economic instability. Investors seeking to preserve wealth amid persistent fiscal irresponsibility may increasingly turn to precious metals, commodities, and other real assets as a safeguard against currency devaluation and systemic financial risks.
There's no one-size-fits-all answer.
Yeah.
It's very difficult for me to understand why somebody wouldn't own physical gold.
Yeah.
Because I believe that a replay of the 70s, in a financial sense, is inevitable, you need to look at what worked in the 70s. During the period where the US dollar lost 75% of its purchasing power and other countries did worse, the gold price increased 30-fold.
Yeah.
Now, will it increase 30-fold this time? Unlikely, because it's going from a higher base.
Yeah.
But gold has done well during periods of time when faith in fiat currencies has been shaken. And I think it will be, because of the arithmetic, shaken. So to start with, everybody needs to save something in gold. I'm not saying abandon the US dollar or the British pound. Maintain liquidity in the currencies that you spend, but maintain your savings in gold. If you are willing to do some work, if you have the psychological constitution to tolerate volatility and risk, then invest in the gold stocks, and if you have money left over, speculate in the juniors. Those are three different businesses. Savings, that's gold. Investing, that's the big gold stocks. Speculating, that's the gold juniors. They're three different businesses.
Yeah.
Everybody should be in the first business. Everybody should save in gold. People who are willing to do some work and take some risk and endure some volatility should invest in the biggest and the best gold producers.
Yeah.
People who are willing to do a lot of work, who want to outperform the market, who are seeking alpha, can speculate in the juniors, but they need to decide what bucket they're in and for how much. I would be delighted to be wrong.
Yeah.
When people say to me, Rick, when is the gold price finally going to move? I scratch my chin sagely, and I say 2000.
Yeah.
In the year 2000, gold was $250 an ounce. Now it's $28.50. Gold is up sevenfold in 24 years. It's gained 8% compounded. Gold has done its job for 25 years.
Yeah.
People, of course, are saying, when is gold going to double? I don't know. I don't care.
Yeah.
That isn't the purpose of savings. The purpose of savings is to maintain your family's purchasing power over time.
No, I agree.
And gold has done a spectacular job of that. And it's done a spectacular job of that for 25 years.
As of March 5th, 2025, several concerning indicators have emerged regarding the U.S. economy. Recent data suggests a potential contraction in the first quarter, Q1, of 2025. The Atlanta Federal Reserve's GDP Now model forecasts a 2.8% contraction rate for Q1 GDP growth. This significant revision from earlier estimates is attributed to a substantial increase in the trade deficit, which reached a record $153.3 billion in January, largely due to a surge in imports ahead of anticipated tariffs. In contrast, economists from Goldman Sachs project a modest growth rate of 1.6% for Q1 2025. This discrepancy between forecasts raises concerns about economic stability and highlights the uncertainty in current economic conditions. The implementation of new tariffs on imports from Canada, Mexico, and China is expected to have notable economic repercussions. These tariffs are projected to increase inflation by 0.7% to 1.2% and decrease GDP growth by 0.6 percentage points. While they may generate significant federal revenue, there is concern that these tariffs could lead to noticeable price increases for consumers, thereby affecting consumer spending and overall economic growth. These factors collectively contribute to concerns about the current state and future trajectory of the U.S. economy. The economic warning signs we're seeing, rising debt, escalating interest payments, trade deficits, and the impact of new tariffs are all pieces of a much larger puzzle. Rick Rule's analysis suggests that these fiscal challenges are not just temporary fluctuations, but part of a long-term trend of unsustainable government spending and debt accumulation. Historically, governments have resorted to inflation to reduce the real burden of debt, and we may be witnessing the early stages of a similar cycle today. If Rule's predictions hold true, we could see an accelerated loss of purchasing power for the US dollar, increased volatility in financial markets, and a growing shift toward hard assets like gold as a hedge against economic instability. Whether through deliberate policy choices or unintended consequences, the government's approach to managing its debt could have profound implications for investors, businesses, and everyday consumers. So, what does this mean for you? Staying informed and prepared is more critical than ever. If you found this analysis insightful, make sure to like this video, share it with others who need to hear this message, and drop your thoughts in the comments. Do you agree with Rule's assessment? What strategies are you considering to protect your wealth in this uncertain economic climate? And don't forget to subscribe and turn on notifications so you never miss an update on critical financial trends shaping the future. Thanks for watching, and we'll see you in the next video.